There's a fundamental difference between wealth and income. You can have $1 million portfolio, but if it doesn't generate cash flow, you're still dependent on selling assets to live. Income investing solves this. Today, we're examining 10 exchange-traded funds that pay consistent dividends, turning your portfolio into a monthly paycheck machine. These aren't your grandfather's dividend funds. Modern income ETFs use covered call strategies, high-yield bonds, and options overlays to generate yields between 7% and 12% annually. Some pay monthly, one pays weekly. Let's break down each strategy. Starting with QQQI, the Nasdaq 100 Income ETF. This fund holds the Nasdaq 100 index and sells covered calls against the positions to generate monthly income. You get exposure to Apple, Microsoft, Google, Amazon, the tech leaders, while collecting monthly distributions typically yielding 7 to 9%. The trade-off, you cap some upside during explosive rallies, but for income investors, that monthly cash flow matters more than capturing every percent of growth. SPYI applies the same concept to the S&P 500, broader diversification, lower volatility than pure tech, and reliable monthly income. This is perfect for conservative income investors who want market exposure without sector concentration risk. MAGI takes a different approach, concentrated exposure to the Magnificent 7 tech stocks with option strategies, higher risk, higher potential income, and direct exposure to the companies driving market returns. JEPI is the 800-pound gorilla of income ETFs, over $30 billion in assets, JP Morgan's flagship income product. It holds low volatility stocks and sells equity-linked notes to generate consistent monthly income around 7 to 8%. JEPI has become synonymous with reliable income ETFs because it actually delivers, month after month, without cutting distributions. JEPQ is JEPI's tech-focused sibling, same strategy but applied to Nasdaq 100 stocks, higher yields, often 9 to 11%, but more volatility, for investors who want income but believe in tech's long-term dominance. Devo takes a traditional approach, just high-quality dividend stocks selected by active managers. No options, no leverage, just companies with sustainable competitive advantages paying consistent dividends. Lower yield around 4 to 5%, but dividend growth potential and less complexity. Week is unique. It's structured to pay dividends weekly, 52 paychecks per year. The psychological impact matters. Instead of waiting a month for income, you're getting cash flow every Friday. The fund uses short-term option strategies to generate these frequent distributions, typically yielding 10 to 12% annually. BTCI brings income investing to cryptocurrency. The fund holds Bitcoin and sells covered calls against the position to generate monthly income. This is controversial. Bitcoin is volatile and selling calls caps upside. But for investors who want BTC exposure while generating yield, it's an option that didn't exist 2 years ago. BALI combines high-yield bonds with growth stocks for balanced income. OMA replicates Berkshire Hathaway's portfolio with an income overlay. Both offer unique exposures you can't get elsewhere. Here's the strategy. You don't pick one. A well-constructed income portfolio combines several of these ETFs, maybe 40% in JEPI for reliable base income, 20% in QQQI for tech exposure, 20% in WEEK for weekly cash flow psychology, 10% in Devo for quality dividend growth, and 10% in BTCI for alternative exposure. Now you have diversified income sources, multiple distribution schedules, and different strategies working together. Your total portfolio yield could hit 8 to 10% with much lower single fund risk. Income ETFs aren't perfect. They typically underperform in explosive bull markets because covered calls cap upside. They're tax inefficient. Distributions are often ordinary income, not qualified dividends. But for retirees, income-focused investors, or anyone who needs cash flow without selling, these 10 ETFs transform portfolios from wealth on paper into actual monthly income.